Good morning. Welcome to Forex In Four. Today is Thursday, November 23rd, 2011, and it's the day before Thanksgiving here in the U.S., and right now in the markets it looks like there is nothing to be thankful for. And we're taking a look here at the euro, and you can see I'm just showing you on the 30-minute chart. I'll back this out a little bit, but we had been having a little bit of support here around 34.30 area, and you can see that area just crushed and came breaking right down. And it looks like now, if we back it out a little bit, I'll put this on a 2-hour chart here for you. Yeah, you'll see that we're starting a new downtrend. You can see here how the Bollinger Band's set up. We're sort of acting as a little bit of a channel there, a sideways channel, showing you where the range was trading. Well, it looks like we've broken this range to the downside. We had the S1 pivot support broken on the daily, all right, and then we broke down the previous week's lows. So what's going on in the Eurozone? Well, the big news is that Germany had an auction of 10-year notes, and they failed to receive bids for 35% of them. So what this is it's called a bid to cover, and what that means is that they didn't get enough interest in people buying their bonds at whatever the levels were. So there's an auction that comes out, and essentially what happens is that the demand determines what the interest rate is. Well, because there was low demand, interest rates go higher. So Germany's interest rate now is moving higher, in addition to all of these countries that are troubled in the Eurozone. And now, why is that significant? Well, there's a couple of things going on there that we need to talk about. And this could just be market games, but it could be something a little bit more detrimental to the overall markets and economy. And essentially, all right, it's kind of like, when you think about U.S. debt, all right, people say, well, rates are low in the U.S. and people will always come in and buy U.S. debt because it's a flight to safety. Well, that's true, but at what price, right? All right, interest rates are so low, people have to sort of hold their nose and buy them. But all of a sudden, if the market starts saying, hey, you know what, wait a second, we don't want to start buying these notes, all right, then interest rates are going to have to go higher to encourage people to come back. So people are saying, we don't want German notes right now. Well, why don't they want German notes? Well, there's a couple of things. A, they could be concerned about Germany's exposure to all of these PIGS countries potentially defaulting, whether it's Italy, Spain, Portugal, Greece, whomever, all right, and their banking system. All right, so maybe they say, listen, we essentially have German debt right now. It's paying a much higher rate via Spain bonds or Italian bonds. Why would we pick up the German Bund at these very low interest rates? All right, the second thing is that they might be sending a message to Germany saying, hey, listen, you know what? You guys need to really step in and handle this euro debt crisis via the ECB. And the idea that euro bonds need to come around is something that you need to reconsider. Because if we don't decide not to lend to you, all right, your interest rates are going to start going up. If we don't start taking your bonds, all right, your interest rates are going to go higher. And then, wait a second, now you got a big overall problem. So, there's dual action going on there, but very significant. I mean, this is an absolute disaster is what they're calling it in the market this morning, and you can see it reflected here in the euro. All right, the other big piece of news out of the Eurozone was that industrial orders came out, and they came out, let me see, where is it? Yeah, much worse than expected. They're expecting Eurozone 6.1%. They got 1.6%. The month over month was supposed to be in minus 2.7%. They got minus 6.4%. So that was a big deal. All right, PMI figures came in. They were mixed. All right, I'm not going to run through all the different PMI figures, but not looking so hot. All right, the other big news overnight was that China, all right, their manufacturing PMI figures came in 32-month lows, reading of 48 versus last month's 51. All right, and let's take a look. You can see it reflected here in the Australian dollar. All right, on a 2-hour chart, we've just been slowly moving lower, lower, lower. If we break it out, I'll come over here to the 30-minute chart. You'll see that when this figure was reported, boom, we got that move down lower. So that's really been the catalyst for selling here. The euro thing came back on top of it, all right, but we've got risk aversion going into the Thanksgiving holiday tomorrow, and essentially we've got sort of 4 days off in the market. I mean, U.S. markets will be open for a half day on Friday, but we're closed tomorrow, half day Friday, then Saturday, Sunday. Okay, there's a lot of time in there where something potentially risky could happen in the marketplace. So, sometimes it's tough for investors to go into these holidays, long and strong, so to speak, with risk appetite going. So a lot of times they just sort of lighten the load, clear the books, and they get away. So you'll see that we're in clearly in a risk-off mode right now. You can see U.S. oil's pulling back. All right, WTI back to right now 96. All right, and we'll look at Who do we want to look at? Let's look at the pound here. Just want to show you the pound here real quick because they had the release of their Bank of England rate policy meeting minutes. And what's important about that is that in the UK, we know that the Bank of England has just turned and they've increased their asset purchase program. Well, the idea is that we want to see where they are as far as what they think about further stimulus. And it was a unanimous vote saying that they may need to raise the target for their asset purchases. All right, so saying that they may need further stimulus. So that's pretty dovish if you think about that, because they're nowhere near tightening. They're going to be easing monetary policy because of the austerity. But don't forget, the UK economy has been fairly resilient. I mean, I have to say that, the numbers don't look fantastic, but, this has to be expected when you undertake government austerity. And I think, when you look at these people in government and they say, we need to produce these growth numbers, these GDP numbers, so that, we keep moving forward, because if, 2 declines in GDP means we're in a recession. Well, if government spending's been such a large part of it, all right, due to the economic crisis that we've had over the last 3 years, and you're reducing government spending, all right, declines in GDP, in my opinion, aren't that bad, because you're not putting it on the taxpayer and on the budget deficit. All right, you're actually improving. So it's kind of like, if you're a homeowner and you have a household and you decide to decrease the household budget so you can save more. All right, that's not a bad thing. All right, you might not be enjoying yourself as much because you're not buying as many discretionary items, but you're saving for a rainy day, you're cleaning up your own balance sheet, you're paying off debt. That's actually a good thing. So we'll have to see what happens with the GDP report, which is going to be coming out tomorrow for the UK. So that's the big news coming out tomorrow, that and German GDP. And this will be, of course, while we're on Thanksgiving holiday here in the US and markets are closed. Obviously, Forex market will still be trading, probably lighter volume. So today in the US, we've packed in all of the numbers essentially, and we're going to basically get everything that we would get over the course of Thursday and Friday. We're going to get it today. So that means 8:30 a.m. we've got a bunch of stuff happening. US durable goods orders coming out. Personal income figures are coming out. Personal spending is coming out. Personal consumption expenditures coming out. Initial jobless claims are coming out. All right, and continuing jobless claims. So those are all those numbers packed in. That's just going to be 8:30 a.m. Eastern Standard. And then, of course, after that, we're going to get the University of Michigan consumer confidence figures, and then the oil numbers a little bit after that. So all that's taking place today because obviously we're closed tomorrow. So could mean some volatility right around that number until it gets sorted out, and you're going to have to take a view of, is this number positive, or is it, is the aggregate positive, or is it negative? Because we could continue in this downtrend, or we could potentially do a little bit of a reversal here. You can see dollar strengthening, which is interesting here, versus Japanese yen, and we had a big move up there earlier as well. And we're starting to get back to the okay, the dollar is the real safety trade when stuff seems like it's starting to hit the fan. All right, if it's just normal, it looks like economies are weakening, that sort of thing, Japanese yen takes a little bit of precedence. All right, but when it's the structural, stuff can happen, then U.S. dollar seems to strengthen. And yesterday's action was interesting. I'll show you this. I didn't even talk about yesterday, but yesterday we got this little bit move higher here going into the close of the day, and that came about as a result of the IMF saying that they were going to expand an emergency lending facility to Europe for the debt crisis. So what does that mean? It means essentially the United States is going to come to the rescue with some sort of lending program because the Europeans can't get it figured out themselves. So that's a good thing, I suppose, from a market stabilization perspective, but perhaps not if you're a U.S. citizen concerned about the debts that are going on and where this money's coming from. So that happened yesterday, and then obviously we got the sell-off. All right, and then the other piece of news here in the U.S. is that the Fed is going to ask that the largest banks in the U.S. undergo stress tests again to see what it's going to look like if we have another global economic catastrophe, which apparently doesn't seem to be too far away based on what's going on in Europe. So they're going to ask them to do stress tests, what their exposure is to European debt and all these other things. So a lot of stuff going on today. I think they're going to try and pack it all in. I think you might see some squaring of the books today and people getting out of the risk positions ahead of, let's just call it the 4-day weekend for the holidays. So, right now things don't look so hot out there, but these are the times when other things can happen. You come in and the world isn't going to implode overnight or just because we have a long weekend, but that risk is heightened. So perhaps we'll see some buying opportunities here come early next week. So just looking at the Aussie, all right, looking at pound, looking at dollar CAD. Whoops, that was a bad call. I thought maybe we'd see that turnaround yesterday, but that didn't happen. That's really what we're looking at today. So, for those of you who celebrate Thanksgiving, enjoy the holiday. I'm going to be celebrating tomorrow, so we'll be off. There'll be no video, no blog article, but I'll be back with a quick recap of today or tomorrow's action, and then Friday for you on Friday. So that's what I've got, gang. Happy Thanksgiving and good trading to all.